There is a question I get quite frequently. Paul, I got this big sum of money. Do I put it in the market all at once, or do I put it in a little at a time? Now, there are products that are actually designed to do this, where you put money into an annuity and you put it in all at once, and then it spreads it out over a period of a year, maybe, putting in maybe a little bit each month. And this is a marketing method that investment advisors use because it gets people to invest where they might sit on the sidelines, otherwise gets them to move. Well, we actually took the data on a deposit of $120,000 versus putting in $10,000 each month over a year. And looking back at the data from 1970 until now, we wanted to see which did better. My asset mix is a long-term growth mix, 75% stocks, 25% fixed income. Now, what we found is in 1970, you would have done better by putting money in a little at a time, dollar cost averaging, $10,000 per month versus putting it in lump sum, $126,000 versus $123,000. And we did that every single year to see what the numbers look like. And here they are from 1970 through 1978. What we found, short version, is that putting them in a little at a time in monthly deposits, the average at the end of the year was $127,000 versus $135,000 if I put it in all at once. There were only 7 years where it did better putting the money in a little at a time versus 41 years, far more, if I put it all in at once. Big difference. Now, here was the real surprising thing for me, is if you looked at the dollar cost averaging years, the difference in accumulation wasn't as big, nearly as big as I thought it would be versus putting it in lump sum. The difference is you can see right here in the numbers. Now, the idea of dollar cost averaging was when the market is down, I buy more shares. When the market's up, I buy fewer shares. So I should be playing the market correctly when I do that. So the idea, dollar cost average or put it in lump sum, you're usually better off lump sum.